And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of GTR Africa 2025. ABSA is a registered FSP. Your story matters. Good evening. Welcome to the program tonight. I'm Stephen Grootes. Obviously a big focus on the national budget. And the big question around the 0.5 percentage point increase in VAT this year and another next year is, will the DA really bring down the government over this? And I have to tell you, my gut tonight suggests they won't. I think they'll turn around, say to their supporters, you voted for us to keep the EFF and MK out of power. Therefore, we had no choice but to accept the VAT increase. That surely is the easiest thing that's going to happen here. Obviously, a lot to come. My understanding, in fact, is that there's sort of 2 months for Parliament to come to some agreement. So, in other words, there's a lot of time for horse trading, arguing, shouting, screaming, pushing, shoving, and then hugging, shaking of hands, and people coming out of some closed door somewhere and saying, we have a deal. So there's plenty to come on this process. We will check with this with Charles de Wet, but as I understand it, we actually are in a position now where if you are working, you are probably paying more of your income in tax once this budget comes into effect than you ever have in the past. And that, I think, is significant. I don't say that to stir a tax revolt or anything, just to point it out. It also tells you the demands on government at the moment as things stand. And yes, there's been this promise of a big review, a sort of attempted reform by the National Treasury. I'm not convinced that the politics is going to align for that to happen. And I think I'm being quite careful with my words when I say that. We'll have full reaction for you, of course, and just look at all of the main points in the budget as well. A lot of money that's going to be spent on infrastructure over the next few years. There'll be one or two questions around whether the institutions have the capacity to actually fulfill the infrastructure, if they'll actually be able to spend the money to fulfill the promise that's been made. We've seen in the past sometimes that people don't actually have the ability to spend the money, to actually do the money, to actually invest the money in the way that they're supposed to. Good to hear from you as well tonight on 011 883 0702 021 446 0567 and voice notes this evening on 072 702 1702.
702. Stephen is on The Money Show.
6 to 8 p.m.
You probably know most of the main points of the budget by now. The VAT increase of 0.5 percentage point now, 0.5 percentage point next year. Government will spend more money on health and education to make sure there are more teachers and nurses and doctors, and a lot more money on infrastructure over the next few years. The Director General in the National Treasury is Dr. Duncan Pieterse. Duncan, good evening to you. Welcome back to The Money Show. Firstly, a VAT increase this year and another one next year. Why have you chosen that option? We understand it's the easiest to implement. Are you really going to get enough money from a 0.5 percentage point VAT increase?
Good evening, Stephen, and to your listeners. So in terms of why we've chosen the option, let's start there. Of course, when you are trying to raise the kind of funding that we are trying to raise to offset the spending pressures in health and education and in particular in infrastructure, you need to target one of your large tax bases, your large three: personal income tax, corporate income tax, or value-added tax. And value-added tax of the three is the one that has the least harmful impact on economic growth and is also the most efficient from a collection point of view. It is also the tax where, relative to our global peers, the tax rate is still quite low. And so that, in combination with the measures that we've put in place to mitigate the impact on low-income households, which include zero rating, above inflation increases to social grants, not increasing the fuel levy, as well as the spending adjustments, make us confident that this is the right thing to do. In terms of raising the right amount of revenue, we are confident, as I said, that VAT is an efficient source of raising that revenue. And certainly in the past, when we have increased value-added tax, we have been able to increase that revenue in line with our expectations. In particular, when you take out the impact previously of VAT refunds having gone up. So provided VAT refunds perform in line with our expectations, there's very little risk that we won't be able to meet the revenue targets from a VAT perspective that we've set for ourselves.
You've also, I presume, deliberately decided not to adjust personal income tax brackets for inflation. So there'll be some bracket creep. You get more money there too.
Yes, absolutely. So because the 0.5 percentage point increase in the first year does not quite get us to match the spending increases that are being put into the budget, we needed to supplement the VAT increase with another tax base, and that is personal income tax. And we have not increased personal income tax rates, but we have not provided bracket creep relief, which also gives us some additional income. And it is a form of increasing taxes because, of course, typically what we would do, which is what we will start doing again from next year onwards, is that we will adjust the brackets for inflation. But this year we are not doing that in order to make up the shortfall.
The amount of money you have to provide for wages for civil servants, as the Minister said in his speech, the 3-year wage agreement is higher than you had planned for. Are you expecting more productivity from government workers in return? Do you believe you'll actually get value for money from government workers?
Well, I think a key part of the productivity discussion that we've been having is how do we help departments to rejuvenate their labor force through early retirement. And so it's important to look at the wage bill additions in the context of the additional funds that have been made available for early retirement. And these funds are meant to be used by departments to align their wage bills with the number of employees they have, because there are quite a few departments currently that are overspending in that front, and two, to rejuvenate their departments by allowing those above 55 who want to exit, and then the department can keep those savings and, of course, use it to bring in other employees, and that will likely have a positive impact on productivity.
You're also going to conduct a reform process, basically to make sure that money is being properly spent, that money is being spent how it should be spent. I'm sorry to say this, but I'm a little cynical about whether this government really has the political will to cut back on spending simply because of the situation that we're in at the moment. I mean, would government really make a decision to cut back spending on a particular area if it touched any political constituency?
Yeah, I think the commitment that the Minister of Finance has made is that there's quite a lot of very good technical work in this area that's been done by the National Treasury. We have over 200 spending reviews that have been done by the National Treasury as well as provincial treasuries. We have quite a lot of recent work that's been done on how we can consolidate government's public employment and active labor market ecosystem, where we have quite many different programs across different departments. So the work on how we can get more efficiency from government spending has already been done in many cases, and the Minister has committed to taking that to Cabinet and putting those the outcome of that work before Cabinet for a decision, because ultimately those recommendations can only be implemented with the support of Cabinet and by the relevant accounting officers and ministers that serve in those departments.
This budget now goes to Parliament. It has to be voted into law. As I understand it, Parliament has, I think, about 2 months to pass it. We know several parties say they won't support any increase in VAT. What happens if Parliament doesn't vote in favour?
Well, there are various stages to this, Stephen, and of course there's been quite a lot of interest in how that would work, in particular today from journalists and also from the investors that we've met as part of our post-budget investor call. I think the first port of call is the adoption of the fiscal framework. The Money Bills and Related Matters Act, which sets out the procedure on these issues, indicates that the relevant committees must, within 16 days or as soon as reasonably possible, report to the National Assembly whether the fiscal framework is accepted or amended. And so that will be the first time that we will hear from Parliament. Of course, on Friday, we will be formally tabling the budget in front of the joint committees, and then within a few weeks, those committees have to indicate whether they accept or amend it. And the process by which that happens is very clearly articulated in legislation, including the role of the minister in that process, as well as what the committees then have to do. So we will be following that process with the parliamentary committees over the next few weeks and engage them on that basis. And then as we go through, it will then become clearer what the future of this budget will be.
But I mean, if government can't pass a budget, it's not really a government, is the question.
Well, fortunately, the Public Finance Management Act, the PFMA, does make provision in Section 29 for instances where we do not have a budget. And Section 29 says to us that if a budget is not timeously passed, then the relevant departments can continue to spend on areas that have been previously funded or appropriated up to a limit of 45% for a few months. So there are certain provisions in the PFMA that allow for government's business to continue while the actual budget is passed. As you would know, typically the financial or the fiscal year starts on the 1st of April, but the Appropriation Act is often only passed by June or July every year. And that's then when we rely on these other provisions for government business to continue while the legislative process is finalized.
Dr. Duncan Peterser, thank you very much indeed. Director General at the National Treasury. You with the Money Show, 20 minutes after 6. Sia Beniza is an economist and CEO at Political Economy Southern Africa. Sia, good evening to you. Do you think it'll get to that point? I mean, would the DA bring down the government for 0.5%?
Good evening, Stephen. I think at this point we're not sure which way it's going to end, but what really is clear is that, you know, the kind of challenges we had in meeting and creating a consensus at local government level during the sort of the period post 2019 is pretty much being mirrored at the national government level. And I think the first time where we need to have consensus with the GNU government in power, it's quite clear that the different parties are diverging on which way to take the country. And the budget is just one indication of this. It's also clear, I guess, in the policies that we're taking moving forward. And it's quite a pity that we are actually diverging at a time when we need to be actually creating, consensus and responding to quite challenging differences in the global economy, but also challenging conditions here in the country.
The optimist in me is looking to the huge amounts of money that government wants to spend on infrastructure, on railways, on roads. I mean, PRASA and SANRAL both are going to get a lot more money, it would seem. But government agencies often battle to spend that money effectively. PRASA's had contract decisions overturned. SANRAL's contracts can be hugely contested. The money's been announced. Do you think it's going to be spent properly in a way that'll actually make a difference?
So I think in this regard, I'm sensing a mixed bag. So on the one hand, we've been spending so much on infrastructure for the last 10, 15 years. We're hardly yet to see any impact in terms of economic growth. I think various studies in different parts of the government, from the central bank and some non-governmental organizations, has been clear that the link between infrastructure spend and economic growth isn't quite clear. Then you raise, obviously, the issue around the governance and actual effective expenditure of the money that we allocate towards infrastructure. And I think that's the missing piece in this whole strategy. The other piece that I see missing is a clear cooperation between the various government entities. For example, one of the key findings of the Article 4 consultation by the IMF for this year is that exports are really the key area that has been identified that could create jobs, but also spur growth, but is being heavily undermined by volatility of our exchange rate, which prioritizes financial and capital flows in order to balance our current account deficit. But, you know, if National Treasury was able to coordinate with the central bank, but also with other line departments in order to have a big push towards driving exports, I think this is a strategy that would be more effective in driving economic growth. Except what we're seeing is sort of the silo working and pretty much business as usual on the part of Treasury, despite what we're seeing in terms of the global environment as major shifts in terms of the thrust of the US and also what's happening in the global economy has a direct impact on the South African economy, which means we cannot be continuing with business as usual, and we need to actually perhaps experiment with different types of strategies, because the infrastructure spend strategy hasn't actually delivered much over the last 10, 15 years.
Sia Beneza, thank you so much. Economist, CEO at Political Economy Southern Africa. Listening to all of this, Gina Skuman, the economist at Citibank. Gina, good evening. Thanks for your patience. Sia is right, isn't he? This is a dangerous moment to have some kind of political fight over the budget. There is so much going on internationally that the last thing we can afford is to not actually have certainty.
Yes, absolutely, Stephen. I think that if I had to rate the budget, it would be very different from rating, or actually, if I had to rate the budget, I'd have to split it between rating National Treasury versus rating government. Because National Treasury, by following through with a VAT hike or any kind of tax increase, is actually just doing what they've always said year after year, that if there was some unforeseen expenditure pressures or new expenditure pressures, they would have to increase taxes. And they've been telling government this for a very long time. But now you have government turn around and start to create a huge amount of uncertainty. And that's where I would rate the budget down in terms of government's involvement in the GNU. South Africa was on a very good path in the second half of last year in terms of the GNU creating more confidence and a more hopeful outlook for the economy, and then naturally spurring on this view that reforms and structural growth, you were just talking about infrastructure spend and all of that. So that has led everyone to upgrade their growth forecast. But now we have this huge cloud of uncertainty hanging over our heads. You know, will the budget pass in Parliament? Will the GNU actually keep itself together because of this? It all seems to come down to a disagreement on VAT. So there are bigger fish to fry. So, yes, I do agree with you. There's a huge amount of uncertainty, and I do think it's unnecessary.
The one big positive I can see from all of this is that very few people are suggesting we take on new debt. I mean, that's got to be a positive. People are talking about that, looking at cutbacks, but no one really seems to be saying, oh, we should just increase the debt.
Oh, absolutely. I mean, that would be the most vicious circle you could find yourself in, because if you issue debt in order to pay for new spending in an economy that hasn't been able to generate sufficient growth, all that's going to do is kick up bond yields, which increases your debt servicing costs, and there you've done yourself a disfavor by increasing spending by just certainly your messaging. So I think one thing I would say is that while the GNU might disagree on the ways to go about balancing the trade-offs between the new expenditure and tax increases and obviously where they've landed on VAT, it does come across from Treasury very strongly that what the GNU does agree on, which is a very good thing, and I hope they promote this more, is that the GNU is in agreement that there is a need for fiscal consolidation and debt stabilization. That is a very strong message. And again, I know the DG was on here, and I really hope that that message is promoted more by the GNU so people realize this debate or this argument around VAT is a smaller part of the problem, whereas actually the broader picture here is that they all agree that South Africa needs to consolidate and improve its fiscal standing, and we just cannot take on more debt. We can't afford to.
Gina Skuman, thank you so much. Economist at Citibank.
The Money Show.
The markets.
Patrick Matidi is head of multi-asset strategies at Alawani Capital Partners. Patrick, good evening. The market reaction to the budget, so many other factors, particularly happening internationally, also the big sell-off among platinum shares today. I suppose difficult to kind of judge it.
Yeah, good evening, Stephen, and thanks for having me. Indeed, it was a fairly volatile session, especially after the sell-off overnight from our global markets led by the U.S. On our side, we sort of ebbed and flowed, between positive and negative, finally settling on a negative, down about 0.2% on the JSE. But the currency was also quite under a bit of pressure, especially up against the euro, where we are seeing, possibilities of perhaps a ceasefire that has bet, the euro against all major currencies, including the JSE. But over and above that, Stephen, I think there's a lot of uncertainty still with regards to the budget and how to play out. And I think if you look at the bond market, despite a weaker rand, it's kind of held up reasonably well. I think the fiscal stance that has been taken has been fairly encouraging. But I think there are also other points of uncertainty that could play out and therefore upset the market in the next couple of days.
A lot going on in the United States. CPI out slightly softer than expected, so inflation lower, and which obviously this captures sort of before tariffs. We've had some heavy days on U.S. markets. Both the Nasdaq and the S&P are slightly up today.
Yeah, absolutely. So that inflation number came in, kind of gave the market a bit of a relief. It came in a bit better than expected. But I think if you look at the markets, especially the U.S. over the last couple of sessions, it would appear sentiment has since shifted away from inflation fears as a result of these tariffs to more a reflationary, sort of a bit of a recessionary impact, that could play out as the year progresses. So you are seeing the U.S. 10-year, being very strong, starting to price in a lot of recession risk as opposed to inflation risk.
And then Growth Point, very quickly, their results out today, slightly better than expected. Was an increase in office vacancies, I noticed, which is surely a comment about Gauteng once again.
Yeah, at Growth Point, it's almost like the bellwether. It gives you a nice feel of what's happening in the property sector because they have exposure to pretty much all the sectors, from office to retail to also industrial. So the numbers are interim, so halfway through, up about 3.9% at the headline level, which gives you some indication that maybe for the full year it could be somewhere close to 10. But you are right. Some of the levers are starting to move nicely in the right direction, especially vacancies, especially out of the office portfolio and industrial portfolios.
Patrick Matidi, thank you very much indeed. Head of Multi-Asset Strategies at Alawani Capital Partners, bringing the time on The Money Show to 6:30.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, your views on the budget, please. 011 8830 702 021 446 0567 and voice notes tonight on 072 702 1702. Plenty of questions around the increase in VAT, 0.5 percentage point. Plenty of questions too around whether this is the best way to bring in money. And then, of course, the political dimension and what is going to happen with the Democratic Alliance refusing to support this. But plenty of other questions around it as well. Charles de Wet is an executive at ENS in the tax practice. Charles, good evening to you. So we have the 0.5 percentage point increase in VAT. We have bracket creep for many people. The top tax bracket is already 45%. Would it be correct to say at this stage that after this budget, South Africans are paying more of their income in tax than ever before?
Hi, good evening, Stephen, and I agree with that completely. This fiscal drag or bracket creep is a stealth tax. We've now had 2 years in a row where there's been no adjustment for that. Last year, they collected an additional 16 billion rand. This year, they're going to collect about 19.5 billion rand. So if you look at the tax-paying public, they've effectively got that much less to spend in the circumstances. So tax rates have definitely increased because of no adjustment being made for inflation.
It really is extraordinary. I mean, I suppose a VAT increase, I understand the logic behind it. We spoke to the Director General in the National Treasury. It is just 0.5 percentage point. And to me, it may seem like a silly number, but I suppose all of that really does add up.
I think it does add up. In terms of collections, they're talking about sort of 13 billion. 1% gives them 30 billion, so they're not, taking exactly half of that. So, I think that it does result in additional revenue. But I think that the concern is, to implement a VAT change from a business perspective is complicated. And, whether systems can in fact, cater for a 0.5% increase is going to be interesting to see. And then to do it sort of 2 years in a row, this year and next year. So I think the compliance cost associated with that is probably exceptionally high. Obviously, that's not SARS or Treasury's problem, but business's problem. But I do expect that there are going to be a significant amount of challenges in terms of implementing that, and to try and get the reporting right and run potentially 3 tax rates over a period of time in respect of debtors, in respect of bad debts, etc. I think it's going to be complex.
I mean, systems just aren't designed to do sort of half a percentage point. And I mean, a lot of human brains, I find that very difficult to do too. So, I mean, that suggests that actually this could be quite complicated. You also have to factor in the fact that the number of zero-rated goods has been increased as well. So obviously government will lose a little bit there, but I suppose ordinary people are getting a little something back.
Yeah, so I mean, if you look at the products that have been changed, I mean, they're all now added onto the zero rating list. They're talking about the sort of 2 billion rand. I think that's potentially understated a little bit in the circumstances, but it's, I mean, pretty much sort of offal of all animals and dairy liquid blends, and then also canned vegetables. So, from a cost perspective, the canned vegetables is probably the biggest one, and there's always been this debate as, why canned vegetables different from fresh vegetables. But, I think that that certainly households will have their costs will decrease a little bit as a result of that. But I still, if you look at the basket of goods, the 1% increase is probably going to be higher than the additional zero-rated goods. I mean, the other point that I would make about it, I think there is a technical problem in terms of actually implementing that list on the 1st of May, which is the date that they've announced. We need legislation and definitions to get that sorted. And I think it's going to be interesting whether it's possible to deliver on that in the short time frame that we have.
I'm going to enjoy watching the lawyers argue over the definition of the word offal. Charles de Wet, thanks very much indeed. Executive at ENS in the tax practice. Listening to that, John Manyike, the head of financial education at Old Mutual. John, good evening to you. Really appreciate the time. So we're all paying a little bit more tax. This is going to sting, isn't it? Because we've already had to tighten our belts so much.
No, absolutely. It will sting a bit, but I think we must also be thankful. There's quite a number of good news. No fuel levy in the horizon. That's good news. No inflation adjustment on personal income tax. Look, I think there's some good news, but the budget, I still say, is not final because the political parties will be horse trading. I don't think DA is violently opposed to a small increase in VAT, but it certainly represents a leverage, to negotiate for certain things. I'm sure DA would have loved to see some changes in terms of this land expropriation without compensation. So they're going to use that, of course, to negotiate for something. Same with the EFF. I think there are specific things they are looking for. So it might remain, it might not remain, but I don't think there's any budget that can make everybody happy.
I mean, I think for many people, it may just be a kind of step down the road in which our lives have just become more difficult financially. The costs of things have gone up. I think there's also a feeling that maybe we're getting less from government in terms of services, even roads, than we did, say, 10 years ago. And I worry that it feeds into a sense of frustration with government. But people are having to pay for more services for themselves while government is extracting more from them. It's a very tough time.
No, absolutely. I mean, I would have thought, of course, increasing VAT should be the last option. I still think perhaps there's a missed opportunity with regard to the informal sector, So what about gambling? Why not consider something around gambling? We still have the taxi industry. They're not paying tax. So I still think there are pockets of opportunities where government could raise revenue. I think it's a good move to give SARS some budget to help improve, some tax collection. But I still think maybe we may have gone to the VAT increase because it's a soft option, but I do think there are many other missed opportunities that government could have looked at.
John, the sort of sense of frustration people have, you're right, and I'm glad you did point to the lack of increase in the fuel levy. That's an important point. But I think that people are just battling to get by. Some households are sort of, one tiny push away from kind of financial disaster.
No, it's true. Look, the cost of living is still a problem for many South Africans, and I think if you look at how people are dealing with debts, although it doesn't mean that if a person is struggling to manage their debt, that justifies why government shouldn't push for increases here and there, because we need to learn to be prudent with our personal finances. But the reality is the cost of living remains high. Yes, inflation has gone down, particularly if you look at food inflation, which has really helped a great deal, and as a result, we're seeing the central bank starting to cut interest rate. But I don't think these interest rate cuts has reached a level where people could say, well, yeah, now I'm starting to see a difference. I think it's a journey.
John Manyike, thanks very much indeed. Head of Financial Education at Old Mutual. In a moment, Busi Mavuso, the CEO of Business Leadership South Africa.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, proud sponsor of GTR Africa 2025.
Well, of course, as you know, many voices that need to be heard on the budget, particularly on a day in which VAT goes up by 0.5 percentage point. Also, a lot more money being spent on infrastructure. Busi Mavuso is the CEO of Business Leadership South Africa. Busi, good evening. Plenty of political parties opposing the VAT increase tonight. Are you going to join them?
No, I was going to rate this budget as 7 had it not been for the VAT increase. So it's rather unfortunate, especially when you look at the fact that the average South African consumer is under immense pressure. So putting on a 1%, and by the way, he says 0.5% now and 0.5% next year, possibly. I can tell you now that 0.5% next year is a guarantee. It's not a possibly. I think it just didn't want to put it all at once, because it didn't want to shock people and didn't want to upset people. But I think what really stood out for me and what was quite encouraging, Stephen, was the 4 pillars on which economic growth is anchored. He speaks about maintaining macroeconomic stability, he speaks about implementing structural reforms, accelerating infrastructure investment, and improving state capability. If we really want to achieve, he speaks about 1.8%, but remember the business-government partnership at the beginning of the year spoke about 3% economic growth. And it was really anchored on these things, especially the infrastructure investment, which is going to be coming from transmission, 14,000 of transmission lines that have to actually be put up. I think we're planning to put up about 2,000 this year. The improvements that is going to be made on transport and logistics, the private sector participation that is actually going to be coming in. The DOT minister has now put up a PSP unit in her office to accelerate the facilitation of private sector. They are going to be bringing in a lot of money to upgrade, to improve the efficiency, whatever maintenance that needs to be done on these lines that they're going to be taking over, the water infrastructure, the e-visas that are now in place, which are going to bring in a whole lot of tourism, the generation that, not on the pipeline in terms of the PPPs and the renewables that are actually going to come onto stream. So that is actually quite encouraging. And I actually like the fact, Stephen, that the 1 trillion infrastructure investment is actually going to be focused on these 3 network industries. We've been talking about network industries for quite some time. Energy, transport, logistics, and water, and that is precisely where we need to be focusing if we want to see economic growth. So the plan is a legitimate one and an achievable one.
Sure, but I mean, we heard earlier on the Money Show analysis suggesting the problem is always that, yes, the money will be spent on infrastructure, but we don't actually see any return on that investment. We often don't even see the infrastructure.
We actually have to give this kind of investment as well as the structural reform agenda some time. Because remember, just take Transnet, for instance. Look at how much business Transnet has lost to Mauritius, to Namibia, to Mozambique because of their failure to take the goods out on time, in terms of exports and goods sitting in for many weeks, in the ports from an imports perspective. Now, you've lost that business. People have actually established good relations with the other ports, neighboring ports. So do you really think it's going to be an easy a piece of work to try and convince these customers to actually come back. So we need to understand that we actually need to do the work and prove that the work that we've put in place is going to be sustainable. We need to prove that actually the interventions and the reforms that are being put in place are actually going to be sustainable, and they are not actually going to leave business, hanging on a ledge once again. So there is that bit to say that you do the investment now, but the trickle effect, is actually going to be seen a few years, into the future. And I think same with the visitors, Stephen. People already have chosen some other countries as investment and probably maybe as tourist destinations. Coming to South Africa is going to be no easy fit. There's going to be a lot of marketing and putting our foot forward that we're going to have to do to try and convince all of those people to come back.
The National Treasury also says that it'll start a review process, a reform process on government spending. Busi, any ideas on where they should start, where government should cut back on spending?
Let's start with reducing the size of the cabinet. Let's start with the huge entourages that all of these ministers and their deputy ministers have. Let's start by defining first, what are deputy ministers for again? What does the success metric look like for them? Because it doesn't make sense that you're going to be spending so much money on keeping people when you actually don't have clarity in terms of what they are meant to achieve and what their jobs are. So if we are going to be all asked to actually ensure that we tighten our belts, can it start with national, with government, and really putting those things out there and doing some of the things that are actually going to give the rest of us confidence, as it were. But I'm actually not convinced about a committee being set up for wasteful expenditure. What powers is this committee going to have, Stephen? Because something like this needs to be monitored, delivered, done within the department. Because if you're going to be someone sitting out, is it going to be inviting businessmen again like he did? So if I'm going to be sitting on that committee, I'm going to do all of this review. I'm going to write recommendations. How many recommendations, how many papers, how many committees have actually submitted legitimate work to the president? Start with PSEC, SOE reform. That paper that was given said, President, you don't need 743 SOEs, you need 6. And maybe to be honest and maybe to be fair, work is underway to try and see how you bring private sector participation, how you break some of the monopolies. But we have a long history, of committees being set up, recommendations being made, and that not being given effect to, and we don't know what ends up happening in as far as that. So there, I think we're just kicking the can down the road.
Busi Mavoso, thank you very much indeed. CEO at Business Leadership South Africa on The Money Show, bringing the time to 7 o'clock. This Eyewitness News is brought to you by Alex. Alex, for the businessman who knows what he wants.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of GTR Africa 2025. Absa is a registered FSP. Your story matters. Good evening. Welcome to the second hour of The Money Show. I'm Stephen Grootes. We'll speak to Alex Thomson after 7:30. He is the CEO of the co-founder of Naked Insurance. You have him to blame for all of those billboards. Let me just have a quick look. Yeah, he didn't arrive naked. I suppose the optimists among us may think there's still hope when we speak to him a little later, but just also an insight into how the insurance industry works and why they believe it works better without clothes. You'll have to ask him why he believes that. But we'll be talking about that and speaking to Alex Thomson a little later. Looking forward to that conversation. He's your shapeshifter this evening. How COVID changed the workplace? Well, where do you work would be the first question that I would ask. We'll talk about that in a moment. And then, of course, Wendy Nola, looking at what happens when you sell a home and there's been no thorough inspection beforehand. She'll be your consumer ninja in the next little while. Good to hear from you tonight. Your thoughts on the budget. Also, any horror stories you have in selling a property. 011 883 0702 and 021 4460 567. Voice notes this evening on 072 702 1702.
The Money Show.
Business Unusual.
One of the biggest, longest-running conversations in the world of work has been about the impact of the pandemic of COVID-19, what it changed forever, what could still change back, and how it's really changed how you work now. Advita Naidu is Africa MD at Jack Hammer Global. Advita, good evening. I mean, before the pandemic, Zoom meant one thing. 2 weeks later, it suddenly meant something else. And a lot of that hasn't really gone back. If someone says now, let's have a quick meeting, in the past, that would mean coffee, a trip. Now it means something completely different.
Yes, and I think some of us are better for it. Those collaboration tools are very good for on-the-fly kind of working and to get something quick done. And then in other instances, it has hampered productivity, it's hampered connection. So, we have changed the way we work, but not sure it's always for the better.
So, that's really the question around productivity. And then I suppose the turnover of staff as well. For some people, opportunities sort of arrived that were just not possible before. Suddenly they became possible because geography didn't matter, or it certainly seemed like that. But it must be having some sort of impact, hybrid working.
Well, sure. I think, there have been studies that say that hybrid work does have impact on productivity and employee retention. And I think most of the productivity gains have come from the reduced commutes, the enhanced quality of life, reduced burnout, and thus lower attrition. There have been studies that say productivity was boosted up to 25%, but it starts with a figure like 3 to 4%. Then some studies say 25%. And there's really not been any consolidated or consensus over what the actual productivity gain has been. But we do know that there's higher job satisfaction. There is less commuting stress. There's improved work-life balance, which then when it results in lower burnout, it can't be ignored. I think in South Africa, the impact does vary by industry. The knowledge sectors have the increased efficiency because everybody has the ability to work remotely. But then other industries that require the on-site presence, like manufacturing and retail, they've struggled to adapt because their back office workforce expects the off-site privilege, but then there isn't this wholesale adoption. And so there's inequitable time and resource allocation, and it just gets messy. And I think it's all about effective implementation and how to make the concept of hybrid work for you.
I'm fascinated by how US companies now, big ones, seem to be demanding that all of their workers go back. At least sort of 3 days a week is becoming the norm, it seems. And I know in some cases this has been led to quite a lot of sort of unhappiness, but they certainly are making that demand, and they wouldn't be doing it. It's expensive for them to have workers back, so they wouldn't be doing it unless they felt they had to.
Yes. So I think recently McKinsey's put out a study that said, 34% of employees were in office in 2023, and that was up to 68% last year. And definitely that was driven by employer mandates and not employee preference. I think the point about being back in office is, again, because that productivity can't be measured, and we still don't know for sure whether employees are being as effective as they can off-site. A lot of companies are requesting the return to office, but with a little bit less rigidity than we had pre-COVID. I think they've acknowledged that there are some gains to be had from working at home from time to time, and then the gains that are to be had in office are, working towards a purpose-driven environment, is providing a space for collaboration and a way for innovation to take root without forcing the issue.
Social skills still matter at work, right? And that ability to turn a greeting from literally to go from a greeting to a meeting, and then to turn that meeting into a deal. That comes from face-to-face interaction. There might be virtual things later. You can sign the contract virtually, whatever, the final details. But that moment where you bump into someone at something and you then get to talking and then you swap a number. I don't think that happens virtually at all. And a lot of businesses about deal making, your network, LinkedIn wouldn't exist without it. Surely that face-to-face stuff matters.
Yes, so I think, I have a lifelong thesis around this. I say, transactions are concluded on a screen, but relationships are built in a room. And that in-person component is absolutely going to accelerate progression for yourself professionally and for your organizational ecosystem. It allows for immediate feedback. There's hands-on training, the opportunity to absorb the nuances of the environment more quickly. It facilitates a deeper understanding of workplace dynamics and the etiquette, which you're right, absolutely wouldn't happen on a screen because we get very transactional on a screen. We start with the social niceties and then progress into the meeting, and we miss the body language and we miss the ideas that spark just based on what someone else says. So that there is a big element of collaboration and innovation that's lost.
The thing that worries me at Vita, and I've made this point on air several times, maybe even to you, is that one of the costs may be hidden and therefore difficult to quantify. And I'm talking about the cost to younger people, first-time entrants into the workforce. And I keep making this example. I learnt, and yes, it was journalism, but I learned so much sitting in a room with people who are older and more experienced than I. I've spoken to other people about this because I thought, maybe it could just be me. And that is not the case. Many people say they've learned so much from older people. And it's not just someone coming and saying, don't do this or anything like that. It's just watching. And that means that the cost might not be quantifiable. And I worry that we may actually find businesses are less productive than they used to be, or their people are, simply because they never got the same induction into a business or the face-to-face experience that my generation had.
You're absolutely right. And while we do warn our clients and businesses that they risk losing top talent if they don't offer some sort of hybrid arrangement, we do caveat that for younger people, first jobbers, much of what you learn in the office environment is not explicitly taught, but it's absorbed through observation and interaction with your colleagues. And it's this informal learning that, it's about how to conduct yourself professionally, the informal and the formal, the career advancement that comes with these intangible opportunities. And you're right, it can't be quantified just yet, but we know that it matters.
I mean, I suppose the thought experiment is, if there was no commute, if your home was next to your office, would you go into the office or would you work from home? I think most of us would go to the office.
I think most people would, because one of the biggest complaints that came out of the forced lockdowns and people working at home was that it was difficult for them to transition from work life back into home life because their office was right next to their bedroom or in their bedroom. So it was very easy to send one last email and suddenly you find yourself going down a rabbit hole of work and being absolutely unable to switch off. Whereas we know that in the car on the way home, we decompress a little bit. So that separation of workplace and home place does make a big difference.
Well, it's because people listen to, good radio on the way home that they decompress. The future of work, hybrid working, urban geography changes. You find coffee shops in residential areas because they're actually serving people who are working. Are we going to still see a lot of hybrid working? Are we still going to see the sort of, regional offices in some places where you work with people who are in completely different fields, but all of that sort of thing still going to happen?
Yeah, so I think there have been a lot of headlines about companies requesting a return to office, but those are very scary headlines. There's no nuance in them. Realistically speaking, a lot of companies are opting for the hybrid approach. So they're intentionally setting certain in-office days or setting core hours in office, and they're still allowing employees to benefit from the flexibility that they had in a fully remote. And so we've seen a shift towards more flexible, purpose-driven environments. There's been a rise in co-working spaces, hot desking, even in larger corporates, office hubs that are designed for collaboration and not necessarily daily attendance. So you might find one team in office on one day and other teams another day. I think, South African commercial real estate is showing that as well. And then, like you say, the benefit of working in a coffee shop is being exposed to people whom you don't work with. There is that diversity of thought and that learning through osmosis that happens in an environment like that, or just a change in space that really can be quite inspirational.
Advita Naidu, good to talk. Thank you very much indeed. Africa MD at Jack Hammer Global.
The Money Show.
Consumer Ninja.
Well, I don't know if you've heard of the phrase footstoots. And what that really means is that if you're buying something, a car or a house or a building or some form of property, you buy it as it is. In fact, I've seen it in legal documents described as footstoots. I have no idea what the origin of the phrase is. You may well know. Well, I was reminded of that because your consumer ninja, Wendy Nola, looking at the issue around property inspections and what happens if, in fact, there's a problem. Wendy, good evening. Fascinating to actually look into this because there are certain things that you need to be very careful of.
Indeed, I think we need to accept that in many cases, there's issues with a house that the buyers sort of don't want to be known, and because they're afraid that it will scupper the deal, or they'll have to sell at too low a price, and so they paper over the cracks, do a quick paint job, and hope for the best. Yes, when you buy a home, they produce what's called a I forget what it's called, but it's a list detailing every area of the house and whether there are any known defects, and the buyer can go along and say no, it's fine. And then the deal goes through and the new buyer, the new owner moves in, and then there are problems with the boundary wall, or there is damp, or the whatever. And so now what happens, because I had one of these cases come to me just this week. A woman moved into a new home in Westville in KZN, and almost immediately there was damp, there was mold, it was hideous, really, really bad. And she's like, can I cancel the deal? I said, well, the transfer's gone through. You can, if you can prove that there was a deliberate, you were deliberately misled, there was a deliberate failure to disclose the damn problem, then you've got, a legal case, but you've got to hire a lawyer, and these things take time and money. And she's in total despair. And I said to her, I'm sorry to say this, but I've spent many, many years urging consumers, before you sign that offer to purchase, please. There are many companies doing it, several top ones in particular. It costs about 3,500 rand for the average size home. Obviously, the bigger the home, the more time it takes for a proper assessment. And they will come to you with a report that will reveal any of the nasties that you couldn't see, and then you can walk away or negotiate a lower price. But people don't want to spend the money, Stephen.
Sure. And what kind of issues are most often found? I mean, when you do these inspections, what do they find?
So a big one is roofs, big one, poorly constructed or badly maintained roof that might cause you problems down the line. And it's also about insurance, because, we have to take homeowners insurance if we have a bond, right? And I've seen many. I've had two in the past week where the claim is rejected because of I think we've discussed it, Stephen, the past couple of weeks, where they say this wall wasn't built according to the national building regulations. And the poor homeowner says, but how am I supposed to know that? Well, if you got an assessment done before you bought the house, you would have found out. So that's roofs. There are no plans. It's a big one for the LAPA or the whatever that was added. Big one, non-compliant geyser installations, damp, as we've mentioned, and not built to the correct building standards, which is going to trip you up one way or the other down the line.
And do we know,
those are the biggies.
The percentage of buyers who get the property, I mean, how many people are actually having their property professionally assessed?
Well, you hazard a guess. It's probably lower. It's between 3 and 5%, according to House Check, which is one of the bigger companies. Between 3 and 5%. So he's got, the House Check is in all the major centres, and he says, in the Cape, they'll, the average property value that they're seeing is 6.5 million, which is really high because it's skewed by the sort of 20 millions or 100 millions, those properties. But yeah, the average, if you take out those outliers, you're probably looking at 3, 4, 5 million. And people are just, it's a lot of money. It's your prime investment for most people. And they won't spend the 3,500, 4,000 rand, whatever it is, to get an assessment done. I just don't understand it, Stephen. I just do not understand it. And I say that, I admit, as somebody that hears from people when things go wrong.
Sure.
In many cases, there's nothing wrong. It's fine. But when they go wrong, they're expensive. And it just literally ruins their quality of life and their finances for a long time.
Sure. What happens if the assessor does something and or misses something? So they do the assessment and they don't actually pick up something that's going to cost the new owner a lot of money.
Yes, that's a really good question. I asked that of John Graham of House Check, and he said they have, and this might apply to other companies, they have professional indemnity, so that's insurance against the human error of one of their assessors, as well as public liability. So if the assessor falls through the roof, for example, and if that either one of those payouts, so we're talking to your question about professional indemnity, if the payout isn't enough to deal with the problem, so replace the roof or whatever the case may be, Home Check will pick up the difference. They will pay half and get the assessor to pay half, so the assessor has some skin in the game as well. And he says in all the years they've been operating, That's only happened once. That was to do with something that was missed in a roof.
Sure.
So, but that's a very important question, because you're putting all your faith in this report, right? So, and to that, there's moves to actually make the building inspectors have an actual academic qualification, which should be happening later this year. So that will sort of up the game considerably.
And Wendy, I mean, do estate agents actually get reports on properties? I mean, they're going to sell them. It's their name. I'm sure that if someone has a problem, they'll go back to the estate agents at some point and give them hell.
They do. And then the estate agent says, well, we didn't know. And then, you would have to prove it. So, yes, you'd think that it would be in their interest. But I think a lot of the houses that they're selling have issues that, they'd rather just stay under the carpet in many cases. Sorry, estate agents, you're doing everything honorably. But John of House Check said, yes, some are on board and as a way of building trust between buyers and sellers. So they pay for the assessment to be done as the house goes on the market. So everything good and bad is laid bare transparently. And then the buyer gets to either walk away from the deal and say that's too much remedial work that needs doing there, or the two parties then negotiate a price which takes into consideration what it's going to cost the new owner to remedy the problems. So I think that is very mature. And I would certainly, if I was looking to purchase a property, I would ask the estate agent, agency, is this something that, have you considered it? Why aren't you doing it in the interest of transparency and given what's at stake? And it's certainly a trust builder. So I would say that's a question you should, if you're in the market as a buyer, you should ask. But either way, without an assessment, professional assessment, and that there are various ones, I would always go for the most expensive one because obviously what I see in my work. Do not sign an offer to purchase without it. It is such a huge risk. You don't want your biggest purchase to become your biggest nightmare.
Wendy Nola, thank you, the consumer ninja.
The Money Show.
Shapeshifters.
23 minutes now to 8 the time. So if I say to you, you were at work when you got naked, what do you immediately think about? I mean, is it your worst nightmare? Or do you think of that now really quite irritating billboard that you see on your way to work? And I'm talking, of course, about the company Naked Insurance. You'll have seen they've been a big part of, I suppose, a revolution in insurance over the last few years. I think it's a revolution in insurance that's probably still got some way to run. One of the founders of Naked Insurance is your shapeshifter tonight, Alex Thomson. Alex, good evening. Thanks so much for coming in. I really appreciate it.
Thanks for having me, Stephen.
You started as an actuary, right?
I did.
What was it about numbers and being an actuary that attracted you to that?
Well, I'll tell you a secret. My dad was an actuary too. So, I guess it just sort of...
There's an imagination joke there somewhere.
Probably, yes. And I just think it was something that sounded like a challenge to me. I didn't want it to be easy. All the other courses looked a bit boring. So that was, I think, what appealed to me about it.
All the people I know who've studied actuarial science have told me it's incredibly hard. It's really tough. And it goes to what you say. I mean, how did you find studying for it?
Yeah, pretty tough. I think particularly when you start work and you've still got to write all these exams, I think it's quite a significant challenge to do a full day of work, get home, start studying this difficult material and try to get all that, and have a life on the side. It's pretty tough. Fortunately, I got through the exams relatively quickly, but it was a tough period.
I mean, it takes over your life for a while, that kind of thing.
Yeah, quite right. We've got a lot of actuaries at Naked, a lot of people writing exams, and I always just say, just make the sacrifices. Get it out the way. You don't want it to drag on and on, because the pass rates, the percentage of people that pass are relatively low in a lot of the exams.
Isn't that deliberate? I always thought they fixed it a little bit because they set the number of people who pass. They don't set the pass. They don't set a pass mark. They set a pass rate.
Yeah, well, the other thing that we say is the standards are always slipping. It was much harder in my day,
So you ended up working in the insurance industry. I mean, obviously one follows the other, but was that always the ultimate game, the ultimate goal?
I think in truth, I didn't have any idea. Someone gave me a bursary for my final year of university, and so I started working in reinsurance, in fact, in Cape Town, and stayed in reinsurance for a while. And look, obviously, you learn a lot about insurance in actuarial, and you once you've got the domain knowledge, you think you've got something to add, and so you tend to stay in it. It's not more. It's not more than that. And as as we'll get to on the Naked Story, I think at some point you start wondering about this whole insurance thing and why you're doing it, and then it certainly does. You can have a bit of an existential crisis about the industry that you're in, but it's an industry which plays a very important role in society. It's not clear to everyone, but it really does. And I think when you can bring quantitative and actuarial skills to it, it's really important. Insurance can go really wrong if the numbers aren't done right.
Yes. And they can go wrong in all sorts of directions for you or for a client or for someone else. Okay, so you started in reinsurance. What kind of experience were you building? What kind of knowledge about the industry? What were you learning about it at the time that maybe you hadn't learned as an actuary? And we all know this. You actually have to do something to know it.
You're quite right. Look, I think when you start as an actuary, you tend to focus on very quantitative exercises, and so I was doing a lot of model building, a lot of numbers, and building all sorts of fancy ways of calculating how much money needs to be set aside for future claims, and trying to figure out how to price various insurance contracts and reinsurance contracts. So lots of complicated models and maths and that sort of thing. But I think what it certainly teaches one is how to take a lot of the stuff you've learned in theory, a lot of the kind of like math you do maybe at school, and how to bring it into the real world, how to make it something that is actually practical, that can actually deliver value, to customers, to shareholders. It's a particular thing to move out of the kind of theory and into something which can deliver value, rather than just getting caught up in something very abstract.
So at some point, there came a time when you and your other co-founders decided to make a change. What was the insight? Was there an experience? Was it, was there some big storm that made you learn, actually, this doesn't work anymore? Or was there a sort of long process at which you just felt you were butting your head against a brick wall? This could be done in a different way.
Yes, I was working in consulting at the time, and as was one of my other co-founders. And so we're working with a lot of the insurance industry in South Africa. Really across the board, from big to small, across life and non-life. And there were a number of themes that we saw quite consistently, at that stage. And that particularly, I think, just the use of technology and the impact that technology was going to have on consumers. At that stage, and we are going back, something like 10 years ago, it was. We saw the way technology was impacting many, many industries. People were doing internet banking. People were starting to use things like Uber. But insurance was just getting left behind. It was still done very, very traditionally. And so, there were certainly questions. What does that look like? And while strategically a lot of these companies could see that there was going to be a shift, it was often, like when we worked with them, you could see that what was needed to succeed there was something very different. Everything about the sort of established, we call them legacy companies, everything about them was set up for a very different kind of world. The kinds of products that they had, the distribution channels they used, the systems, and even the people were geared towards a certain kind of thing. And what we saw, the hypothesis that we had, the guess that we made, if you like, was that, that what was needed to really succeed in that world was going to be something very different. So the technology piece was the one big element. But the other side, and I sort of started talking about it earlier, was that when you look at insurance, and we were sort of working with people from the inside, you could see people who had done really well, in their careers, they were quite successful, and somehow there'd been a sort of loss of purpose. The reason that insurance existed, it kind of got lost in the complexity of all of it. And really what was the only focus was how do we maximize the amount of money we make for shareholders? And it became a kind of quite extractive kind of industry in some ways, where, it's really, you've got these customers, and how can we sort of squeeze as much out of them to generate value for shareholders? And it sort of felt as though the balance had swung, and that insurance was not delivering on its purpose consistently enough. That was the concern. That's the thing that we saw from the inside. And so if we were going to start a business, and we were going to make it about technology, we really wanted to try and bake in a far greater level of customer centricity. We wanted to make it really difficult for ourselves to end up chasing shareholder value at their expense. And so we came up with a number of innovations to try to really realign things, to get the balance between customers and shareholders right.
You must have been kicking this around with people for quite some time before you made a move. I mean, I imagine there would be, first a conversation maybe in whispered tones over a sort of coffee machine, and then maybe something more formal later. What was that process like? Because starting a new thing, there's a lot of risk. You would need capital as well. You need quite a lot of things to work before you can even go out and start getting your first clients.
Yeah, that's right. And it was quite a bizarre process in some ways. In fact, when you're in a corporate role, and I mean, we were in a, pretty senior roles, we were earning well. There was no real sort of need to do this at all. And we would be giving up a lot financially from a job security perspective, even reputationally, the risk of the thing completely falling over and maybe struggling to find employment again, that sort of thing, were real sort of worries. And I mean, I think, to be honest, what we'd been doing prior to that was quite far from what we would need to do to start this business, this direct-to-consumer business. We were quite far sort of, in the sort of engine room in the back office of insurance. We weren't really at the coalface. And, so it was a bit of a kind of, let's go and chat to some people and see if there's any interest in funding us. And fortunately, we had quite a long-standing relationship with the broader Hollard Group, and they have a private equity firm allied to them called Yellowwoods, and we went and chatted to them, and we really honestly, really the truth is that we thought they were going to laugh us out the room, and they showed interest, and suddenly you sort of have this moment of, okay, so what are we going to do now? Are we actually going to do this? You feel almost expecting it not to work out, and I think for me personally, I think there was just something about doing something more impactful with my life. It wasn't so much a financial thing. Yeah. It wasn't so much that I was really unhappy with what I was doing, so much as just the opportunity to do something really tangible, have real impact in the world, in the country, do something which I can look back on and say, look, I'm really proud of that. I think that was the thing that sort of said, well, all those risks, all the potential downside, I'm willing to take that on because of that potential upside.
I mean, something that happens kind of mid-career to a lot of people is that debate. Am I going to do this or am I going to do something different? And you took that path. A lot of people don't. At some point, you'd have had to have spent a fortune on marketing because you were starting from scratch. You would have had to borrow the money to do that. You'd have had to set up all of the systems first. And to do that, you'd have had to create an identity. I mean, Naked's quite clever in a way. We all know what that means. There's a lot you can do with the phrase. It sort of stands out. But all of that would have required quite a lot of time, energy, thought, and then money to get it going.
Yes, and I mean, we really see ourselves as a product company first and foremost, in the sense that we really wanted to build something that delivered insurance to people in a completely different way to the way that it had been built before. So, aligned with what I was saying earlier about the use of technology, we were clear that we weren't going to go out and license something from an existing vendor or something like that. We wanted to build everything from scratch using very modern technology, all designed around delivering the best possible experience for customers. So that was really, and so in the early days, we really focused on that, on doing that as best as we possibly could. The marketing really came later. And in fact, I think in product businesses, in technology businesses, it is really, I think, right not to market early on. One really needs to be able to demonstrate that there's what they call product market fit, that what you've built, there's actually demand for, that people actually want it. Then they're going to buy it, not because you've been putting up billboards, but because there's something genuinely valuable. You're meeting a need in a way that's not being met prior to that. And so in the early days, and really in the first several years, marketing was a very secondary undertaking. It was really about building something special, building something that didn't exist, really rethinking the whole way that insurance works.
So at the time, and I made the point that there was a sort of revolution underway in insurance, so you weren't the only ones. I mean, you may have been able to do some things differently or more efficiently or more effectively than others. You were part of a wave. So you would have had to then, you had competition in the way that insurance was changing.
Quite right. and locally, but certainly internationally. I mean, the amount of money that went into insurtech and specifically direct to consumer insurtech around the world was absolutely staggering. I mean, it was considerably harder to raise funding in South Africa, but globally, the amount that went in, I think they were seeing a lot of venture capital firms, things were seeing this new generation of insurance business just taking over everywhere. Of course, something that didn't happen at all globally, that story has played out. But yeah, I mean, it's the competition is, I think was really reflective of this shift that went on. And we've always really focused more on the customer, just trying to understand how well are we delivering value to them rather than, what's going on around us.
We're speaking to Alex Thomson tonight, one of the co-founders of Naked Insurance, your shapeshifter. 10 minutes now to 8. Your shapeshifter this evening is Alex Thomson, the co-founder of Naked Insurance. So, Alex, I mean, you talk about building the business and you talk about the customer, but obviously the money matters. And let me give you a recent example. None of these involve your company, by the way. But I had an experience recently where I realized I was paying over 2,000 Rand to insure a car. I got some quotes around and ended up having another company doing it, not yours, for less than 700 Rand for the same car. What is going on in the background, in the models, in the underwriting or the reinsurance that leads to that kind of difference?
I think the first thing to say is that pricing insurance is complicated. There's a lot of things to consider.
That's what I'm trying to get to. It is complicated.
It is complicated, and I suppose every company looks at it differently, which is why it is worth shopping around, because your particular risk profile might be weighted differently by different companies. At the same time, I think it's also worth saying that if you've been with one company for a long, long time, it's particularly important to shop around. I do think there's a tendency within the industry to maybe let prices drift upwards over time, which might not be the case if you were to go and get a new quote.
Okay, but you still haven't answered my question. Why do they weight things so differently? I mean, why is it that some companies will charge more than double for the same person in the same car? I find that fascinating. And I mean, I said to them, well, why do you do that? And they gave me they didn't explain it, and I felt for the person who I was talking to. But I mean, I just found this really maybe gets to the heart of the insurance industry, if you see what I mean. That's why I asked the question.
Yeah, possibly. I mean, if you've been with your previous insurer for a long time, it's quite possible that they were just drifting your premium up over time, and that's the real reason. And if you'd been a new customer of theirs, they may have also charged you something like 700. I mean, that's not impossible. But I think it's it is really dependent on how typically actuaries, in fact, are building these models, and sometimes the way that they look at different makes and models of vehicles, the way they analyze risk is just different. And so you can, usually look, it's fairly similar. The sort of difference you're talking about is pretty unusual, but certainly it could be 10 or 20% higher or lower, across the market.
You've co-founded an insurance company. You've done a lot of things in your life. I don't know if you get much time off to relax. And there's a sort of running joke at this stage on the Money Show that when I ask CEOs, if you really want to scare a CEO, ask them what they do for fun. And they all say they jog and they spend time with their family. I know you do jog. You run actually quite extreme distances.
Yeah, I do find running is a really good way to spend downtime, and we were saying earlier, I run sort of really early in the morning, it's sort of 5 o'clock, and it's a really good way to start the day. It tends to, I think, just get the energy going and tease up like a really positive day. But I actually really do believe in work-life balance, and I certainly, as I'm getting a little bit older, I do find that, making sure that I have really high quality energy rather than large volumes of time spent at the office or on work is the most important thing. There's a huge difference, I think, in my role being sort of really sort of high quality thinking, being really sort of on the mark about something than just spending a huge amount of time doing it. But I read, every now and then do things like play golf, and I do spend a lot of time with my family. I've got 2 teenage sons, and I really love spending time with them.
It makes everything different. Books that you read, fiction, non-fiction. Do you like the leadership section? I can't stand the leadership section, and I say this to some friends of mine who write those books, but they're aware.
I actually also am not a massive fan of the leadership section or self-help. I mean, I went through a phase in my 20s and 30s where I read a lot of psychology, trying to understand myself and people around me. But mostly, fiction, and I quite like science and philosophy and those kinds of books. And I really like reading, deep thinkers, people who've really spent time like figuring out things. I mean, I find them really just mind expanding, and it gets me thinking, and often you can apply it into your life, into your work in many ways. But there's nothing quite like a good book, that's well written to take your mind off things. I think that is amazing.
I find, everyone talks about AI and writing, and I'm like, it's never going to be as well written by a human. When you're in the hands of someone who's written something well, spent time of it, I find that's really special. And then, do you get to travel very much? I mean, when you go on holiday, are you someone who goes, do you go traveling in South Africa? Do you take the family somewhere else?
Well, I mean, we do the sort of Joburg thing and go to Plet most years, but actually, I mean, we as a family love the bush. We spend a lot of time in Kruger and in other parks. My kids really like it. My wife likes it. So, we all sort of do a bit of birding and, that sort of thing. I think it's just an incredible resource that we have in this country. And I mean, it's incredibly special. So we do that. We do that quite regularly. I mean, with work occasionally, there's a bit of travel, being overseas a bit and that sort of thing. But I mean, there's so much to do in this country.
There really is, isn't there? Yeah. I mean, if you have a family, there are probably 400 places that you could go to in Gauteng and not go to the same place twice. And that's just in one, the smallest province in the country. Insurance, I made the point that the revolution, I don't think, is finished yet. We're going to see a lot more change in insurance still, aren't we? Or are we not?
Yeah, certainly, I think so. I think what's shifted is the focus is now really on what you might call the manufacturing process for insurance, which is really the way in which you deliver the product. I think in the early days it was all about quoting and buying. So being able to do that quickly online. We were I think one of the first in South Africa to offer that. There are a few others now, but what we've really been focusing on is how do we deliver this product to customers in the way that is as seamless, as instant, as just as easy to use as possible. That if you do have a car insurance claim, that what's going on. It's all right in front of you. It's not one of the things where you're wondering what is happening. Do I need to phone in again and see what the status is? We're trying to sort of really re-engineer that whole process. And I think one of the sort of big things that we've seen in our business, the big kind of sort of loops, if you like, the sort of feedback mechanisms, is that by doing that, it sort of takes out cost. We no longer have, people who are doing silly things just like sort of providing updates. People can find it themselves. They can manage the thing themselves online. And what that means is that we're able to then reduce prices and pass those through, and that sort of just feeds the growth of the business. So that sort of self-service, technology-driven, using automation, that sort of thing, and then allowing that to feed through in lower prices is really a key part of our business.
Alex Thomson, I've learned a lot from you. Thank you very much indeed for coming in. I really appreciate it.
No, thanks. It's been a pleasure.
Alex Thomson is the co-founder of Naked Insurance. Blame him for the billboards.